Welcome, everybody, to the October 2021 Quarterly Markets Outlook. I'm joined today with Graham Bibby, Chief Investment Officer. Graham, welcome. It's been an interesting few months this quarter. We've had continued lockdowns in New South Wales and Victoria, concerns in China around Evergrande, etc. What's happening in markets and the economy at the moment?
Yeah, and we've seen quite an interesting period of very bullish run through the middle of the year, and then September we had a period where markets came back a bit, and they were very focused on some of those issues you mentioned. So China, Evergrande, the Delta outbreak, concerns around the US debt ceiling, when the Fed would taper. There's a number of issues that markets were concerned about, but they eventually cleared up once the markets had that breather, and we're finding that people are getting back in, and equities are rallying again.
Australian households, the prediction is around about 200 plus million of money sitting in Australian households, and that figure is more around $2+ trillion in the US. Clearly, households have got some pent-up consumption, and as we come out of lockdown, what's the economic situation look like in Australia, where stock markets are at all-time highs and the property market's booming?
Yeah, it's pretty positive for this quarter and into the end of the year. And we're seeing on our projections and the research that we follow, economic growth really recovering still strongly, and just really edging back a little bit from the absolute peaks, but still very, very strong. And it's a story around, people haven't had the opportunity to spend. Being locked down, you can only have so many haircuts. You can have one haircut, but people are having a go at catching up on having 2 or 3 beers, or more restaurant bookings. So services are really going to come back strongly. That's what's going to help this quarter in particular, and even the goods side of the economy will do well. Households do have a lot of cash, and savings are still relatively high. They've drawn down some of that, but still well above where they previously were.
Yeah. And how about business and consumer sentiment? Are people actually feeling positive about post-lockdown, or are people still feeling a little bit nervous? How's the sentiment out there in your view?
Yeah, it's still reasonably good. So from these charts, you can see from the NAB business and confidence and conditions, it's still reasonably positive. So it's above the zero line on the chart for both current conditions and for confidence looking ahead. So, business has been through quite a big jump up and down, but they're still okay about the outlook, and consumers are still reasonably positive as well. So, we've seen the big shock down and up, but still consumer sentiment is on the positive side of the ledger, and that's expected to continue just as we have this particularly the opening up surge, and people getting out and traveling and spending more.
Yes. Wasn't surprising to see that equities took a relative breather over the last couple of months, given the really strong performance to 30 June 2021. How are we now seeing the outlook for equities into the end of 2021 and into 2022?
Yeah, it was an interesting breather, and one that was probably the largest setback that the markets had over the course of the last year, as you can see from the chart on the left, the S&P 500, and for our market as well. Really, that was around a lot of the concerns of would Delta mean that things are going to remain locked down longer? Would China Evergrande mean a systemic problem across the world? And would the US debt ceiling get resolved? And would the Fed pull the punch bowl away from stimulus too early? So all of those things meant that this was probably one of the most under-owned rallies, and there was a lot of hedging. So we're seeing that in option prices. Now what we've seen is, now that the market's had a breather, a lot of those positions have cleared out, and people are back on the long side, and we're seeing US market back to all-time highs. So we're seeing it continuing to rally into the year end. It's looking reasonably healthy for that.
A number of our clients, when we have a markets outlook, love hearing about a couple of stocks in our portfolio, and the reasons we've selected them. Could you sort of share with us, with this concept of this opening up trade, what we've been thinking about and what we've been implementing in the portfolios on a stock specific basis?
Yeah, well, there's three in particular I can talk about. So, Woodside is part of the energy trade. As we open up, there's just more demand for energy. The interesting thing about Woodside, it's gas oriented, and they're going to benefit from the merger with the BHP Petroleum division. So, that should be good for them. They need capital to continue expanding their gas assets. Another one that's been very strong is Macquarie Bank, where we rotated into that from another sector stock in that particular sector, and this is just better quality, and they've got a really good growth outlook. They tend to go up with markets going up, and also they're just building a funds management business, just adding on more and more funds management divisions into their business. And then finally Ramsay, which is also benefiting from the pent up demand for elective surgeries. You're having to wait 18 months to 2 years to get your knee or whatever done, and you didn't want to go to the hospital before. You want to get it done now. They're going to have massive pricing power, and they're on top of being a quality operator and management team. So we think that's a good play as well.
Yeah, great. And given these, I guess what we discussed today, what's your medium term and longer term thematic outlook?
Yeah, there's a couple of different ways to look at this, and one is on the things that people are focusing on now, which is inflation. We think it's going to emerge over time to be more of a stagflation, that is high inflation, lower growth, more of a story for first half of next year as growth starts to roll over a bit more. And then ultimately, we think that the deflationary forces will win out longer term. So, the impact of technology and other things on that. You also see high debt loads. They're going to have an effect of capping interest rates. There's only so far that central banks can hike cash rates before they actually start dragging the economy and people can't pay the interest. Then you've got energy prices as well. As they typically have gotten up to $100 for oil, then that tends to be a pervasive drag in the economy and takes money out of people's pockets where they'd otherwise spend elsewhere. So that's in the medium term. So that can all work out within the next sort of 6 months to 2 years, depending on how these cycles go. And then the longer term mega trends, we think there's great opportunities, and that's where we're really looking for good managers, good stocks, and good investments to play to these themes. So energy transition, not just environmental, but just more efficient energy, and the infrastructure that's going to be built around that as well. Transport, that's going to be changing a lot with electric vehicles. Communications, just our ability to communicate as we are. What's going to be the travel budgets next year? Probably a lot lower than they were, and a lot more augmentation of virtual reality into the way that we do work. A lot more remote work, and that's connected to some of the the underlying drivers which I mentioned there. Social change with the change in generations. Environment and ESG just really dominating investors' thoughts. Technology is still there and will become pervasive across industries. And decentralized finance, really part of that metaverse and augmented world as well.
Yes. As a final point in closing, how are we reflecting these overall views in our investment offerings to clients?
Well, what we're doing is we're looking for different styles of managers. So we've got value, growth, and quality as part of the management styles, and just looking for good processes that can find these longer term trends. So there's somewhat of a thematic in some of the portfolio strategies that the managers have. We're noting that there's issues with rising rates right now, but they'll come down. So having a bond strategy that's less dependent on just the straight long interest rates and more credit and more private markets as well. So private debt has a really good role. So we're implementing those across the board, and there's other alternative opportunities for wholesale clients as well.
Yeah, great. Thanks very much for the markets outlook. Thank you very much for joining us today, Graham. Obviously, looking forward to your views playing out and hopefully a prosperous start to 2022. Thanks very much for joining us today.
Thank you.